Have you ever pondered what the price of Tesla's stock will be after the stock split in a year? Experts estimate that the price of Tesla shares at year's end will be quite low. Other analysts now differ on the amount of Tesla shares that will be available in the upcoming year. You'll want to see this through to the end. According to one analyst, Tesla's stock might reach $400 in the upcoming 12 months. Experts predict that 2023 will be a significant year for Tesla, particularly in light of the anticipated introduction of the semi and Cybertruck, which many customers are eager to see. But according to Emmanuel Rosner of Deutsche Bank, the significant potential cost savings from two distinct sources might have a significant effect on gross margins. According to Rosner, we now project that Tesla might increase its gross margin by an additional 300 basis points (BPS) in the upcoming year as a result of a favorable mix shift towards lower COGS production sites and the receipt of IRS battery production credits in the United States. According to Rosner, Tesla could achieve an average cost savings of $2,400 per vehicle, or 6.5%, by moving its manufacturing footprint to lower COGS locations and facilities. The new Berlin and Austin plants, for example, are less expensive to operate than the Fremont site. Considering that the base COGS for each vehicle in 2021 is $36,000, this is before the impact of rising raw material prices and inflationary expenses, which are passed on to consumers through higher product prices. Credits for American battery production, located in Fremont and Texas, may also help save an additional $800 per car. The possible $3,200 cost savings per car, when averaged throughout the global market, may result in a 5.5% increase in the average selling price. Rosner cautiously only raises 2023 gross margins by 200 bps, from 29.5% to 31.5%, implying a 3,300 bps rise from 2022 levels, while tempering expectations. As a result, adjusted EPS increased from $6.60 to $7.15, significantly exceeding the $5.82 consensus. Nevertheless, Rosner maintained his buy recommendation for Tesla and increased his 12-month price objective from $375 to $400. Conversely, the street's average target price for the shares is still a relatively modest $311.97, indicating a roughly 8% upside from present levels. According to the analyst's analysis of the consensus breakdown based on 18 buys, 6 holds, and 5 sells, this stock is a moderate buy. However, a Deutsche Bank analyst clarifies that 2023 will be crucial for Tesla. Indeed, Wall Street bulls are still buying Tesla shares in large quantities, citing a variety of possible triggers. In mid-September, Emmanuel Rosner, an analyst at Deutsche Bank, stated categorically that he thinks the Tesla stock rise is only getting started and that the business would likely have numerous catalysts in 2023. We view 2023 as a pivotal year in which Tesla continues to grow volume at a high pace, enters new segments with Cybertruck and Semi, optimizes its manufacturing footprint, and benefits from IRA, Inflation Reduction Act, which will lower its cost and boost demand, Rosner stated. With every 5% increase in the global take rate on new sales, we see significant room for upward revision to our 2023 street estimates. Furthermore, we see additional upside potential for the gross margin from full self-driving, which is not in our base case scenario. Almost the last few months, the stock of the EV manufacturer has increased by almost 40%, surpassing the 8% gain of the Nasdaq Composite and exceeding competitors Ford and GM. Wall Street attributes the increase to hope for new laws that will encourage the use of electric vehicles starting in 2023 and beyond. Investor opinion towards Tesla has also increased as a result of the company's excellent performance in the first 2 quarters of this year. In August, the stock saw a modest decline due to a general market retreat. Rosner anticipates that reduced manufacturing costs will be a major source of future profit for Tesla. He stated, while the company's gross margin improvement has slowed down this year due to costs and inefficiencies from COVID-related lockdowns and ramping up new factories, We believe Tesla is still on track to grow this metric in 2022, according to the analyst. More importantly, looking ahead to next year, we now forecast Tesla could lift gross margin by another 300 basis points year over year thanks to positive mix shift towards lower cost of goods sold production facilities and benefit from IRA's battery production credits in the US, said Rosner. We estimate that Tesla could generate $2,400 per vehicle or 6.5% average cost reduction from expanding its manufacturing footprint to lower cost of goods sold regions and facilities, and an additional $800 per vehicle in the United States from battery production credits in Vermont and Texas, averaged out globally. Starting from a base cost of goods sold per vehicle of $36,000 in 2021 before the impact of rising raw materials and inflationary costs, which the company is largely offsetting through product price increases. He continued by saying that the potential cost savings of $3,200 per car might add up to a benefit equivalent to 5.5% of the average selling price. However, we only cautiously enhanced 2023 gross margins from 29.5% to 200 basis points, which is a 300 basis point improvement over 2022 levels. Additionally, we raise adjusted EPS from $6.60 to $7.15, which is significantly more than the $5.82 consensus. Rosner said that the anticipated 2023 release of Tesla's Cybertruck and semi-vehicles could increase demand. In the long run, as volume increases, we anticipate even greater potential for operating margin growth and more opportunities for improvement in gross margin, according to Rosner. We still think that Tesla is one of the best stories in the auto industry because of its competitive pricing, excellent cost structure, excellent execution, secured supply, and now established more significant capacity to support significant expansion. According to some, Tesla's post-split shares will reach $500 by 2023. Aside from the enthusiasm over the stock split itself, they think there are other favorable catalysts as well. Musk first hinted via Twitter that 2 new electric vehicle models would be released. Tesla 500-mile range semi-truck starts shipping this year, Cybertruck next year, he stated. Additionally, Tesla declared that it had shortened the 8-week delivery wait period for its Model Y in China to 4 weeks. This is encouraging since it shows that there is a high level of demand for the Model Y in China and that Tesla's supply chain problems might be abating. The finest part was probably when President Biden signed the Inflation Reduction Act, which offers a $7,500 tax credit on new electric vehicle purchases that meet certain requirements. This ought to hasten the U.S. adoption of EVs in general and Tesla vehicles in particular. In 2023, experts predict that Tesla will have delivered over 2 million cars. According to an analyst, shares could surge to $360 in the upcoming year. The analyst's optimism is mostly based on Tesla's increasing production capacity. Accordingly, the Wedbush analyst believes that yearly deliveries could increase dramatically the following year, from fewer than 1 million in 2021 to over 2 million in 2023. Although such tremendous expansion might initially appear improbable, Dan Ives forecast. In actuality, Tesla's projection of 2 million deliveries by 2022 is fairly modest. Upon closer inspection, Ives raised Wedbush's 12-month price objective for Tesla stock in late August, citing the company's overall momentum going into the end of the year and improved production rates at its high-output factory in China, from a split-adjusted $333 to $360. It is well known that when the government imposed restrictions on manufacturing operations early this year in an attempt to prevent the spread of COVID-19, Tesla's Shanghai facility experienced significant delays. However, the carmaker reported in its second quarter update that at the conclusion of the quarter, production rates at the significant plant had not only recovered but had reached all-time highs. With investors considering this momentum in conjunction with Tesla's reportedly ongoing progress at its California facility and its stepping up of production at additional plants in Berlin and Texas, 2 million deliveries in 2023 start to look attainable after all. The plants of Tesla are already set up to produce around 1.9 million units a year on an annualized basis. Furthermore, Tesla hasn't said that it plans to reduce its investments in raising its production capacity. Indeed, the corporation has stated that by year's end, it hopes to be using all of its present manufacturing capacity. Elon Musk, the CEO of Tesla, stated on the firm's second quarter results call that the company had a good chance of finishing this year at 40,000 vehicles per week. This corresponds to a yearly run rate above 2 million units. Musk stated at the most recent annual shareholders meeting that the company eventually hopes to have built 10 to 12 factories, with the new one supporting massive output of roughly 1.5 to 2 million vehicles per year, even though the delivery of 2 million vehicles in the following year would only represent a fraction of the company's vision. If you want more Tesla stock predictions, subscribe to this channel.